Welcome back to the New Zealand Property Insights. I'm Paul Roberts. I'm one of the owners of Property Apprentice, and we're here to help you navigate the New Zealand property market with real facts, not just the headlines. So today on episode 25, we're going for a deep dive into the fundamentals shaping property ownership. And is landlording a traditional commercial business, or is it a unique human rights service with special obligations? Following experts' insight published by Stuff, we break down the conflicting perspectives from the Property Investors Federation, Infometrics, tax specialists, and the Human Rights Commission on interest deductibility, profit expectations, and potential landlord registration. We'll also be unpacking a major milestone supply in our second segment, as Stats New Zealand reveals annual home consents of top 40,000 for the first time since 2023, while analysing what rising mortgage rates mean for absorbing that new stock. In our third segment, we'll analyse two groundbreaking Treasury papers on long-term affordability, New Zealand Super, proposed changes to indexation, raising the eligibility rate, and also building private retirement wealth is becoming essential for every Kiwi. Well, isn't that true? This episode is designed to give you a clear strategic view of the current cycle, so let's get into it. So we're kicking off the first segment with the ongoing debate across the property sector. Should private landlords who rent out residential homes be treated strictly as a commercial business, or does the human right to shelter set them apart from other industries? So government agencies like MBIE, Inland Revenue and WorkSafe officially classifying collecting rental income is running a business. However, Stuff recently highlighted through a panel of industry experts opinions on how regulation, tax deductibility, and operational standards should apply. Official government guidance from the Ministry of Business, Innovation and Employment states that collecting rent on a residential property fits the definition of running a business, regardless of whether the property was a deliberate investment or an accidental acquisition. For instance, having a home by having kids and needing a newer home and keeping the first one. Property Investors Federation Vice President Peter Lewis emphasizes that Inland Revenue, MBIE, and WorkSafe all regulate residential rentals as a business, arguing that landlords pay tax on rental profits and should be entitled to earn a return on service provided, just as food or water suppliers do. Absolutely, Peter. Peter Lewis also notes that restricting business operations or freezing prices, pushing rents higher as housing providers attempt to recover compliance costs, adding that private providers supply rental housing more efficiently than any government is very, very important. Infometrics Chief Executive Brad Olsen states that while interest deductibility aligns with standard economic business principles, treating landlording as a commercial enterprise means all business rules, including fair trade principles and healthy home standards, must fully apply. Olsen also highlights that houses sitting in a unique position as both a commercial service and a public good, distinguishing it from purely unregulated commercial ventures. Tax specialist Terry Baucher points out that interest deductibility is not universally guaranteed for all commercial entities in New Zealand, citing financial rules such as thin capitalisation limits for foreign-owned entities. Baucher also argues that small-scale landlords with one or two properties differ from traditional businesses because cash yields are typically low. And that's true. Most investors in New Zealand are mom and dad investors with one or two properties. So with a 2% return on $1 million loan, failing to provide a livable income without relying on long-term capital growth. So the Human Rights Commission Housing Inquiry Manager, Vee Blackwood, asserts that while landlording is a commercial activity, in right duties under international agreements regarding affordability, habitability, and tenure security. The Human Rights Commission advocates for increased oversight and suggesting potential measures such as National Register for Private Landlords or mandatory healthy homes compliance tracking, similar to regulations introduced for property managers. Well, healthy homes tracking and compliance, that is up to your property manager, and that is what is being done. So this debate really cuts to the core of how property owners should approach their portfolios. From a practical standpoint, Inland Revenue, MBIE, treating renting property as a business, which means you have to run it professionally. Peter Lewis makes a very valid point that suppliers of essential goods need sustainable return to keep providing that service. But where many mom and dad investors run into trouble is assuming that owning a rental property is a passive hobby rather than an active commercial enterprise requiring strict compliance and proper bookkeeping. And Terry Baucher's point about cash yields versus capital growth is a vital reality check. If you buy a property with a 2% cash yield and rely entirely on capital gains, number one, how's that been going for you? And how's that going to bail you out? If you're not operating a resilient business model, that is speculatively investing. And that's not what it's about. Yes, that's your long-term wealth creation over time. But buying the property or being sold the dream is not the way to do it. You've got to work it out on how can I keep this property long-term? And if it's costing you a lot of money every week just to support it, that isn't a resilient business model. So looking at properties that have neutral or cash flow sustainably and holding enough liquidity to maintain high habitable standards without going into financial shock when maintenance is required. Regarding Brad Olsen and Vee Blackwood's comments on healthy home standards and tenants' rights, running a professional business means delivering a high quality of product. Providing warm, dry, compliant homes is not an unreasonable burden. It's standard quality. And that control protects your long-term asset value and retains reliable long-term tenants without a doubt. Treating your portfolio as a professional business means respecting your tenants. They are your clients of your business. Understanding your legal obligations and stress testing your numbers at different interest rates as the property market and the economy moves. When you strip away the political noise and focus on robust cash flow, sound leverage, and quality property management, you build a stable wealth foundation that serves you and your tenants over the long haul. So segment 2, the construction milestone. 40,000 consents reached, regional spikes, and mortgage rate trap. So our second segment is fresh data from Stats NZ reveals that a significant milestone in New Zealand's housing supply with annual residential home consents topping 40,000 for the first time since 2023. This represents an annual surge of 19% driven by strong growth in both standalone houses and multi-unit developments. However, Westpac economists point out that monthly dip in June and rising interest rate environment means developers and buyers face fresh headwinds. Stats NZ reports that 40,581 new homes were consented across New Zealand in the year to June 2026, representing 19% increase on the previous year and marking the first time an annual consents crossed the 40,000 threshold since 2023. Stats NZ economic spokesperson Michelle Frayan notes that milestone marks are the strongest annual results since 2023, signaling recovery after several difficult years following construction downturns that began in 2022. That was broad-based across housing types, with standalone housing consents lifting 17% to 18,627, while multi-unit dwellings, including townhouses, flats, apartments, retirement units, rose 21%, while Auckland remained the largest single market by volume, recording 20% annual lift. Canterbury posted 33% annual increase in planned building work. Canterbury and Otago developed the strongest per capita results nationally, with Queenstown Lakes consenting more than 2,000 new homes in a single year for the first time on record. Additional regional support for annual growth consents came from Southland, Otago. Senior economist at Westpac, Satish Ranchhod, highlights a cautious monthly signal with residential consent slipping 4% in June, due to a pullback in townhouse consents following a sharp rise in May. Shamubeel also emphasized that new housing supply is arriving at a time when mortgage rates are trending upward rather than downward, which could squeeze borrowing capacity for first home buyers, property investors looking to absorb an income shock. Despite short-term interest rate friction, Westpac remains constructive on medium-term outlook expecting home building activity to continue lifting through the second half of the year as developers navigate the environment. So reaching 40,581 consent homes in a single year is a significant milestone for our building sector, especially after a long downturn that we've experienced since 2022. Seeing standalone houses coming up 17% and multi-dwelling units coming up 21% shows a supply across the building housing categories. Queenstown Lake topping 2,000 consents for the first time ever, alongside Canterbury's 33% surge, demonstrate where long-term regional demand and capital investment are flowing. It's great to see building volumes recovering, but Ranchhod's warning around timing is a vital reality check for buyers and advisors. Having 40,000 new homes entering the pipeline right as mortgage rates are trending upwards creates a real serviceability squeeze. If borrowing capacity is restricted by higher interest rates, first-home buyers, investors will find it harder to secure finance needed to absorb these new completed builds. And that's 4% monthly drop in June, driven by townhouse pullbacks. That shows that developers are acutely aware of those lending constraints. They know they cannot simply build without ensuring end buyers can actually secure the finance to settle. And don't forget, the OCR review is again next month. This is why buyers looking at new builds need to be extremely disciplined. Remember that brand new builds still fully exempt from LVR's DTI caps, which is a major advantage for buyers seeking leverage. But you must stress test your cash flow, even on today's interest rates or even higher interest rates, and ensure your builder is financially sound. And confirm your loan structure before committing to a contract. We haven't seen one of those yet that doesn't bleed money each week. So please be aware of the sales pitch and some amazing spreadsheets. Maybe don't tell the full truth. Segment 3, Pension Sustainability Challenge, Treasury Forecasts, Index Levers, and Private Retirement Security. So we're looking at a couple of analytical papers released by Treasury that look directly at the future of New Zealand superannuation and long-term fiscal health of the country. This report clarifies with an aging population driving up pensions and healthcare costs, there are no simple fixes to maintain a state superannuation without significant structural trade-offs. And this has been one of those political footballs that has been around for a very long time. Treasury has released 2 analytical papers as part of preparing for its long-term fiscal statement, examining the sustainability of New Zealand super through potential changes to pension indexation and rise in eligibility age. Treasury projects that highlighting that an aging population will substantially increase the state pension costs alongside mounting healthcare demands, requiring future government choices across revenue spending and public debt. Ratio of working age New Zealanders relative to those aged 65 is projected to decline from 4-1 today down to 2-1 by the end of the century. New Zealand superannuation currently costs the government more than $20 billion per year. The first Treasury paper evaluated pension indexation, noting that changing current formula, which links super directly to the average wage growth, to price inflation or mixed indexation model, would reduce state fiscal requirements while encouraging workforce participation and private savings. A second paper raised the eligibility age, indicating that the qualifying age would need to rise to 75 and 79 if consumption taxes funding rise in healthcare and pension costs to keep superannuation spending at its current proportion of GDP. Treasury models indicate that raising the eligibility age to 70 by 2060 would reduce gross pension costs by 1.64 to 1.84% points of GDP, delivering an average gross saving of 0.33 to 0.37 percentage points of GDP per year raised. Net of tax savings from raising the eligibility age to 70 would equal to 0.23 to 0.25 percentage points of GDP for each additional year the retirement age is raised. Simplicity economist Shamubeel Eaqub notes that tinkering with the indexation or eligibility age provides only marginal fiscal benefits, arguing that shifting towards an Australian-style model of combining private superannuation provision and means testing is the only structural solution. ANZ senior economists emphasize that maintaining the status quo is not cost-free, and as an unaddressed pension cost would ultimately require higher taxes, reduced public spending, and increased national debt. Treasury researchers stress that pre-announcing policy adjustments and phasing changes over time is critical to give individuals significant notice to adjust their lifelong saving consumption and workforce plans, and I would say your investment plans. These Treasury papers are a vital wake-up call for everyone in New Zealand. Looking at our demographic ratio shifting from 4 working age people per retiree down to 2 working age people per retiree at the end of the century shows us why the status quo cannot continue unchanged, or we need to open the doors. New Zealand Super already costs $20 billion a year. And if the government does nothing, future taxpayers face higher taxes or reduced public services. So this is why, as a financial advice company, what stands out to us is Shamubeel Eaqub's comment about tweaking the eligibility age or indexation only moves the needle at that margin. Whether the government eventually raises the pension age to 67 or 70, or moves to means testing like Australia, the message is crystal clear. You cannot rely solely on a state pension to fund a comfortable retirement. And I don't think you ever have been able to. Shamubeel also highlighted that we have an increasing number of Kiwis entering retirement while still paying rent. So if you reach 65 without owning a home or holding cash flowing assets, relying on a state super while paying market rent creates severe financial stress. That's why taking control of your financial future today is so essential. Treasury explains that it recommends that policy changes need to be pre-announced so people have time to adapt. You don't have to wait for politicians to change the rules. By building an independent cash flowing property portfolio alongside your KiwiSaver, you establish your own financial security. That way, whatever happens to the state of superannuation policy down the track, your retirement timeline is completely secured by your own assets. And this is exactly why we do what we do. We want people to be responsible for their own future and allow people to invest in their own way. No government, regardless of their makeup, whether it be the left, the middle, the right, should be there to provide super for everybody as it stands. Everyone has the same choices to make. Everybody has the same opportunities. It's up to you to make the change. Do not rely on governments to do it for you. So that wraps up today's episode of New Zealand Property Insights. We've analysed whether residential landlording should be regulated as a commercial business or a human rights duty, building consents crossing the 40,000 new home limit, and Treasury reports outlining long-term sustainability challenges facing New Zealand superannuation. If these decisions, the building consents, the long-term pensions, made you realise that you need a personalised financial plan and support, or you want to understand your own buying rules in this changing market, we're here to help. So we invite you to come along to one of our completely free online events called How to Succeed with Property Investing. It's highly practical, data-backed session with Debbie, my wife, to show you how to establish buying boundaries and maximize your borrowing capacity safely. They're absolutely free. There's no sales pressure, zero obligation, but our company doesn't sell property. We're 100% independent and financial advice providers, focusing entirely on your education strategy and support. You can find the registration link directly in the show notes or simply visit propertyapprentice.co.nz to secure your spot today. Thanks very much for listening. See you next time.
Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.